Every empire at the height of its power swears. Its currency is an unbreakable vault. Every government insists its promises are written in eternal stone. Yet, history is not a story of stability. It is a graveyard of permanent systems that vanished overnight. We look at our bank balances as if they were bedrock, but money is not a physical constant. It is a fragile web of collective trust. When that trust snaps, the illusion shatters, leaving those who believed in it holding nothing but worthless paper. The most dangerous financial mistake is the blind faith that our current system is the sole exception to the universal rule of collapse. History is a brutal teacher, but it leaves clear patterns for those who prefer to doubt early rather than lose late. The Byzantine Empire offers a haunting case of the slow economic bleed. For 7 centuries, their gold solidus was the medieval world's undisputed reserve currency. But as imperial ambitions grew, emperors succumbed to a fatal temptation: debasement. They began subtly mixing the gold with cheap copper and silver alloys. To the naked eye, the coin remained the same, but the market eventually sniffed out the rot. Once trust cracked, the empire's economic backbone snapped. This reveals a timeless law. Governments rarely resist the urge to dilute their money to fund their debts. When they do, real wealth always migrates toward assets they cannot touch, tangible things like land and precious metals held outside the state's reach. However, collapse doesn't always wait for a slow decline. Sometimes it arrives as a sudden shock, much like the Black Death of the 14th century. When nearly half of Europe's population perished, the entire economic hierarchy was decapitated. Labor, once cheap, suddenly became the most precious commodity on earth. Meanwhile, land became cheap and abandoned because there was no one left to farm it. Those who entered the crisis with liquidity or essential goods didn't just survive. They became the new architects of society, buying up vast estates for a fraction of their former cost. Crises are history's ultimate wealth transfer mechanisms, ruthlessly punishing the over-leveraged and rewarding the liquid. We often hear the phrase, "too big to fail," but history proves this is the oldest trap in finance. In Renaissance Florence, the Bardi and Peruzzi banking families were the masters of the financial universe. But when King Edward III of England defaulted on his war loans, these unbreakable institutions fell like dominoes, dragging the savings of thousands into the abyss. Whether it's 14th century Florence or the 2019 banking crisis in Lebanon, the lesson remains: money in a bank is not a deposit in a safe. It is a legal loan you have made to a private institution. A loan they may choose not to pay back when the doors slam shut. Consider the reality of the American Civil War or the French Revolution. In both instances, governments under pressure printed money, and until it became a cruel joke. As inflation reached thousands of %, people discovered that a wagon load of currency couldn't buy a single loaf of bread. In those moments, the winners weren't those with the most paper. They were those who possessed skills that the community couldn't live without. A baker or a builder is never poor for long, regardless of what is printed on government paper. Production and utility are the only currencies that never lose their value. History doesn't repeat, but it certainly rhymes. Protection in an unstable world isn't about building a bunker. It's about positioning. It's about holding assets the government cannot print, maintaining the liquidity to act during panic, and cultivating skills that remain valuable even if the banks never reopen. Every crisis is a transition from those who trusted in illusions to those who prepared for the reality of fragility. In a world of shifting paper promises, only the real and the useful will endure the storm.